Today, we're talking about indicators. Indicators are one of the most popular things that you will need to understand, study, and learn how they work to be successful in the stock market. Now, indicators are going to be different lines basically in the stock market that helps us determine support, resistance, and get a better understanding of an average of where that play has been. There are multiple different indicators, and when it comes down to finding your indicator, there are a few key things that you would want to be looking for. Number one, what again fits your preference best? Now you're going to find 20, 30, 100 different indicators that traders like to use on the internet. I'm going to tell you my favorite today and why. But it's very good for you to be able to test these and see which ones work best for your strategy. Number two, you are going to want to use some of the most popular indicators because the most popular indicators are going to hold up as the best support and resistance, because if the majority of traders use these indicators, you are going to get the best feedback from these indicators. And we're going to be talking about that momentarily coming on up. But we don't want to get too far ahead of ourselves, so let's dive into our first lesson right here on indicators and make sure that we have a complete understanding of what they are, how we use them, and how they can make us money. So, with indicators, what are they? What are stock indicators? Well, stock indicators are technical indicators, are going to be heuristic or mathematical calculations based on the price, volume, or open interest of a security or contract used by traders who follow technical analysis. So I know that sounds very confusing, kind of getting that big proper definition. I'll give you guys the Dekmar trades definition. What an indicator is going to be a line within your chart that's going to help you understand if the stock is currently bullish, if the stock is currently bearish, if the stock is currently overbought, or a stock is oversold. That is what the point of the indicators are. It's going to tell us an average moving volume. It's going to tell us if it's overbought, if it's oversold, or if it's bullish, or if it's bearish. So it's good to have indicators on our charts to make sure that we understand which way is the mindset towards trader. Psychologically, which way are traders thinking that this play is going to be heading next? So let's keep on moving on with this. We have two different types of indicators that we want to be breaking down, and we are going to have our overlays and we are going to have our oscillators. Now, if you're still a little bit lost and saying to yourself, Dek, I'm not even sure what an indicator is, give me 2 seconds. We're going to show you examples. So what we have right here is our overlays. Our overlays on our indicators are going to be technical indicators that use the same scale as prices are plotted over the top of prices on a stock chart. Examples would include moving averages and Bollinger Bands. Now, oscillators are going to be technical indicators that oscillate between a local minimum and maximum, are plotted above or below a price chart. Examples include the oscillator, the MACD, or the RSI. So let's start looking at these a little bit better, and let's make sure we get a better understanding about these plays. So one of the best things that we can always do, let's just go to www.stockcharts.com, and once we head over to www.stockcharts.com, we can type in any play we want. Let's type in, for example, REPL. And REPL, we are going to have our overlays and our oscillators right here on this. And when you go to stock charts, you'll be able to get it, right in front of your face right here as well. So our overlays are going to be things that are within the chart. Now, what's within the chart right here? Within the chart is going to be our 50-day moving average. You guys can see that this blue line, that's the 50-day moving average. That's going to be, our overlay. And we also are going to be having what? Our 200-day moving average, and that is going to be an overlay. And when we have this on the chart, we can see that the 200-day moving average and the 50-day moving average shows us over the past 200 days or the past 50 days where the average price has been. Now, again, if we are above the 200-day or above the 50-day moving average, that shows that the stock is currently bullish, and that shows there's more buyers than sellers currently looking at this play. So that's a good sign whenever we're looking to go long on a play, because this stock would have a lot of room to run. Notice how REPL today is holding the 50-day moving average as a support line, moving on off of it, and it has all the room to run. There isn't much holding this play back. It's not like REPL is hitting its moving averages, because when we use these moving averages, and we're going to dive into them a little bit more, we use them as more of support and resistance. When we're above the moving averages, as we are are right now, we again hold as a very nice support line. If we are below the moving averages, they usually hold up as a very nice resistance line. But more to that coming up momentarily. What we want to understand first off are the two different types of indicators, which are of course overlays and of course oscillators. So we just have an easy example of our moving averages right here, which are our overlays. So what would be our oscillators? Our oscillators would be looking at the RSI up top or our MACD at the bottom. So our RSI and our MACD are not within the actual chart right here, are they? No, they're at the top and the bottom. But this is again helping us understand if the stock is overbought or if the stock is oversold. As we know, anything above a 70 is considered overbought. Anything underneath a 30 is considered oversold. So right now, REPL is considered slightly overbought because it has an 83 on the RSI, which means again, this stock obviously has a lot of buying towards it, but it could soon have some sellers coming on in. So we definitely want to be able to understand the difference between an overlay and an oscillator, because you are going to want to be able to pick your few favorite overlays and you want to be able to pick your few favorite oscillators, which I'll be showing you guys momentarily. But overlays are within the chart, oscillators are above or below the chart. So that's going to be the main difference between those two, and you guys are going to want to be able to use both of them as they are going to help you become a better trader. So what an indicator are, as we already talked about, are going to be lines or different tools within a graph that are going to help us determine if a stock is bullish or a stock is bearish currently. We have two different types, which of course are our overlays, and we also have our oscillators. So let's start talking about some of my favorite overlays first, and then we'll move over to my favorite oscillators. Now, my favorite overlays are going to be the 50-day moving average and the 200-day moving average. So why? What are these first off? Well, a moving average is simply an arithmetic mean of a certain number of data points. The only difference between a 50-day moving average and a 200-day moving average is the number of time periods used in the calculation. Obviously, 50 days compared to 200. The 50-day moving average is calculated by summing up the past 50 data points and then dividing it by the result of the 50, while the 200-day moving average is calculated by summing the past 200 days and dividing it by 200, right? So again, there's not much difference between the 50-day moving average and 200-day moving average other than just the way they calculate it, which is 50-day or 200-day. Now, we only use these indicators on the daily chart. Now, we're going to be talking about this in a little bit more detail, but let's just make sure everyone understands this a little bit better. So why do we use the 50-day moving average and 200-day moving average? Well, the simple moving averages are often viewed as low-risk areas to place transactions since they correspond to the average price that all traders have paid over a given time frame. For example, a 50-day moving average is a price that is equal to the average price that all investors have paid to obtain the asset over the past 10 trading weeks or 2.5 months, making it a commonly used support level. We'll get to this. Similarly, the 200-day moving average represents the average price over the past 40 weeks, which is used to suggest a relatively cheap price compared to the price range over the most past year. Once the price falls below this average, it may act as resistance because individuals who have already taken a position may consider closing the position to ensure they do not suffer a large loss. So we've talked about this in our past. Make sure you guys head over to our last YouTube video, which was every trading strategy traders should know, and that is going to be going over support and resistance. And one of those main support and resistance is called detailed, which we go over, which are the indicators. So indicators, the 200 and the 50-day moving average are going to be holding up as support and resistance. This is why I use them. So let's just go through some of our top gainers. And I bet you a lot of times we're going to be able to find that these plays either have support right around that 50-day moving average, or they're going to be having a resistance around the 50-day moving average. And it's going to be the same exact thing, either vice versa with the 200-day moving average. So what do we have here? We can see that the stock bounces. Where did the stock bounce at? Stock bounces right off the 50-day moving average. We can see where does the stock, look to hold up at? Right around, of course, the 50-day moving average. Where does the stock start hitting a little bit of resistance and start turning back on down? Right above the 200-day moving average. So the reason we use these indicators, team, is because these indicators are going to help us be able to determine where support and resistance is at. Now, if you're saying, Dek, why the 50-day moving average and why the 200-day moving average? And that's a great question. And the thing is, when you ask yourself, why these moving averages, just go to any site. We'll just go to, again, www.stockcharts.com. We go to www.stockcharts.com and we can type in any play. Let's just type in, again, AAPL, Apple. What's the ones that come up by default? 50-day moving average and 200-day moving average. And notice again what happens on these plays. We bounce right off the 50-day, we bounce off the 50-day, and blue chips are going to love this. If you guys are a bigger trader and if you guys are interested in playing, blue chip plays, look how well you bounce off these moving averages. For instance, take Tesla for example. Tesla, perfect bounce off the 50-day, perfect bounce off the 50-day right here. You can see perfect bounce off the 200-day moving average right here. You can get these amazing bounces. Apple, right? You come on down towards around Apple, you get a nice hard crack. What happens? You get a perfect bounce off these moving averages. You can see when you get down towards all this clutterness over here, perfect bounce off these 200-day moving averages. So you again, want to use these moving averages because they're extremely strong and they're the most popular. That's what we're getting towards. We go to, again, right here on stockcharts.com. Guess what? We have, again, the 50-day moving average and 200-day moving average. Let's go to another very popular site, finviz.com. Let's type in another place, CTIB. Sure, whatever, CTIB. What are the moving averages that pop up right here? 50-day moving average, 200-day moving average. And since they're the most popular moving averages, those are the ones that most traders are going to use for support and for resistance. And that's what I want you guys to always understand. Support and resistance, team, it is what's going to help us be able to understand where our dip buys are going to be and where our sell targets are going to be. So it's not going to be, hey, we hit the 50-day moving average and it's going to be a perfect sell. Or, hey, we come up to the 200-day moving average and it's going to be a perfect sell. Hey, we come down to it, it's a perfect bounce. But these are, again, areas where you can definitely expect some sort of reversal, or you can see some sort of pullback before it starts moving its way on up. They're great for day trades or bounce plays on penny stocks and microcaps. They're great for long-term investments if you're looking for blue chips. They're the most popular. And since they're the most popular, they have the most strength because strength is in numbers. And I always say, imagine if there's 100 people in the stock market, 100 people in the stock market, and 95 of them use the 50-day moving average and the 200-day moving average. Well, guess what? We're going to be able to see where that stock is going to bounce at, right? Let's just, make this a little bit of an example. Imagine, we have a stock, right? And the stock is starting to, it went on a big time spike, starting to move its way on up. And we have this stock coming up towards, again, the 200-day moving average right here. We have 200-day moving average right here. We have the 50-day moving average, let's say, back down here. Well, what's going to happen? What's going to be the train of thought behind a lot of traders? A lot of traders are going to say, hey, guys, we're coming up to the 200-day moving average. Watch for a possible sell soon. Maybe it hits it. Maybe gets a quick little pop, jumps around a little bit, and then starts fading on off. Right? Because we know the majority of traders start using this. Then we start coming back down to the 50-day moving average. Guess what? We can definitely expect to see some sort of bounce play. But imagine the trader who doesn't use this. Imagine the trader that says, oh, no, Dek, I have my secret sauce, indicator. I don't tell anyone. My moving average, I don't tell anyone. What's this moving average? The moving average is a 17 moving average on the daily chart. Okay. It's like, no one's going to care about that, right? So many people are like, oh, I have secrets in, stock trading. It's like, I would rather tell you guys all my secrets, right? Why? Because the more people that know, the better these play work out. You could have your 17 moving average, right? Whatever this weird moving average is, somewhere like right around here. And you're just like, all right, hey, get ready for, again, the short coming on up. Get ready for this big short, coming up towards 17 moving average, and it blasts right through it. And you're scratching your head and saying, what the heck? Why is my 17 moving average not working? Because a 17 moving average, out of the 100 people on the stock market, you're the only person that uses it. So don't expect to see any sort of difference in the stock's movement. You're the only person that's using this moving average. So we use the most popular ones because strength is in numbers. Right? There is no secret indicators. Secret indicators don't exist. So if anyone ever tries to sell you, oh, I'll teach you my secret indicators, it's a whole bunch of baloney. You know why? Because again, your secret indicator means only you and someone else knows it, which means out of the hundreds of millions of people who are trading stocks, you and this person are, again, the only people using it, which means there's no power behind it whatsoever. So again, make sure you guys are taking that in. Okay? Now, Let's keep on moving here with our lessons, and these again going over some of our most popular overlays, right? Which are again 50-day moving average and the 200-day moving average. Here are some examples. As you guys can see, we do have again VLRX pops up to the 50-day moving average, drops on down, pops up to the 50-day moving average, drops on down. Here's another 50-day moving average example: pops on up, comes on down, pops on up, comes on down, pops on up, comes on down. You can see pops on up, comes back on down. Just like before, as I stated, your 50-day moving average will be support and resistance. Same exact thing, 200-day moving average. Look at, again, all the little pops and drops, back here on this play. We can look right here, right? Nice little resistance, nice little resistance, nice little resistance. I said, you're going to break above it every now and then, but it's also going to hold up as, a very nice resistance line. So we also have one other one we always like to be using. The one other the one other overlay that we always like to be using is going to be the exponential moving average. Now, a lot of traders always ask me, Dek, is the 50-day moving average SMA or is that EMA? The 250-day moving average are SMA, which stands for simple moving average. So those are the most popular simple moving averages. The exponential moving average is something slightly different. An exponential moving average, the EMA, is a type of moving average that places a greater weight and significance on the most recent data. Not again like the 50-day moving average or 50-day or 200-day. This is going to be doing the most recent data. The exponential moving average is also referred to as an exponential weighted moving average. An exponential weighting moving average reacts more significantly to recent price changes rather than a simple moving average, which applies an equal weight to an observation in that period. Now, I know I probably lost you there. Right, I get it, right? Especially when you read it fast. I know stock trading, the proper definition terms make it sound so much more confusing than it is. An exponential moving average reacts more significant recent price changes than a simple applies the equal weight to observations in the period. We're going to, again, get the flux capacitor wrapping over around the, and it's like, what? So again, we don't need that. So let's just break it down to what we just did. What we just broke this down towards with the 200-day and the 50-day moving average, we use the most popular moving averages to be able to determine support and resistance. The exponential moving average, we're going to use the same exact thing. The most popular line there is 13 and 20. I personally just use the 13. If you want to use both, definitely check it out. But the EMA is going to be 13. We only use these on the daily chart, just like we used on the moving averages, and we're going to go over that soon. And this is what I call the flexible trend line. I love it. So if you guys are ever asking me, hey, Dek, I want to do a long-term trade. I want to go for a long-term stock. The exponential moving averages, 13, is something that you would want to be looking at. For example, right here, we could just look at the SPY. The SPY is the top 500 companies in the United States. The SPY, whenever we are above, let's just say a little trend line lesson, as you guys know, whenever we are above a trend line, we are considered bullish, right? So if we take a look right here, we can see that whenever we are above this line, we can see bullish, 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 bullish. And when we crack underneath it, we go bearish. And you can see right here, we're bullish, 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 bullish. And then when we crack underneath it, we're bearish, bearish, bearish. Right? That's the simplicity of trend lines. Right now, I call the the 13 EMA, I call that the flexible trend line. Which means, as you can see, as long as we're above this green line, the stock is going to continue to move on up. And when the stock crosses underneath this green line, this is when it starts moving back on down. And when the stock starts getting back above the green line, that's where, again, you can continue to just hold this play. So if you're looking for any sort of long-term investments, the 13 EMA is a great thing to look at because it shows us when the stock is bullish and when the stock is currently bearish. Now, I know sometimes when we look for these little low penny stocks, it's hard to be able to use the 13 EMA. So it's more, again, for plays that maybe you're looking for a little bit of long-term investments on, or again, maybe something with a bigger float, which is in the medium price range. But even again, like if I take a look on CBIO, CBIO, if it's like, hey, Dek, I want to go long-term on CBIO at 625, I would tell you I wouldn't. Because not only you're below the 50-day moving average, but you're also below the 13 EMA. If you're going long-term on a play, you always want to be at least above the 13 EMA because that's the flexible trend line. CBIO, again, follows the 13 EMA very well. Notice, if you bought this stock, let's say you bought this stock when it crosses the 13 EMA at 510. Look how well it holds the 13 EMA. Look how well it just grinds above the 13 EMA. And you know what? When it cracks the 13 EMA, that's when it usually starts fading on off. If I want to take an example over on NIO, look at 13 EMA. NIO, all you have to do is hold NIO, and as long as it holds the 13 EMA, this stock is considered bullish. But the moment, again, it cracks the 13 EMA, that's when it starts fading on off. Let's take an example, ALT. ALT holds the 13 EMA. Guess what happens when it cracks the 13 EMA? It starts falling. So again, the EMAs right here, is the 13 is what I always use. This is what I call the flexible trend line. And the 50-day and 200-day moving average is what I'm always going to use for support and resistance because they are the most popular. Now, something that you guys saw in each one of those slides were what? Something you saw in each one of those slides were only use them on the daily chart. Now you could see in the top left-hand corner of my chart, there is a D here. Can anyone tell me why I would not want to use them, of course, over in the 1 minute chart right here? Well, I'll answer this for you. They change. So let's just go over to, SPI right here. Okay, so we're going to go over to SPI and we're going to do a little example right here. And we're going to add some of these indicators. So we're going to add these indicators and we can go ahead and we have volume. Yep, modifying. Let's go with periods. We'll go with the 50-day moving average right here. So we're going to add the 50-day moving average. There it is right there. Cool. And then we're going to add again SMA. Cool. We're going to add the SMA and we're going to go with the 200-day moving average right here. Okay, boom, right there. So we have, again, the 50-day moving average and the 200-day moving average. And let's actually just change these, modify these parameters. We'll modify this color, and we're going to put this color right here in the red so we can kind of keep it like our normal chart, right? So there we go. We have our 200-day moving average, and we have our 50-day moving average. Nice. And this is on our 3-minute chart. And our 50-day moving average right now is at 908. Our 200-day moving average at 775. So everyone's good. So we know if this stock comes down towards around 905, that this stock is going to get a nice bounce play. But what happens if someone's in the 2-minute time frame? No, it's riding the 50-day moving average perfectly right now, right? And someone over on a 1-minute time frame says, what are you guys talking about? The 50-day moving average is at 974. Someone again is over in a 10-minute time frame. You guys are completely lost. No one knows how to trade around here, I'm guessing. The moving averages are down towards around 780. Someone again is over in a 5-minute time frame. No, they're all the way back down towards around the 830-ish mark. So notice, when you guys change your time frame, the moving average right here always changes. So what did I say before? Our strength is in numbers. Most people, they're going to be in a 1 minute at this time and a 2 minute at this time, which is good. But it's not like every single person is going to be in the correct time frame at the right time. So there's going to be people in the 5 minute. There's going to be people in the 3 minute. There's going to be people, again, maybe in the 15 minute. Who knows, right? So, but the thing is, people are always going to have it on their daily chart. So the daily chart is what's always going to be holding nicely. The daily chart is what's always going to be bringing in some good momentum towards it. The daily chart is where you have the strength in numbers. So that's why I don't use any of these moving averages on the minute chart, because they're not. I don't want to be the guy that says, hey guys, get ready for a bounce play. I look for a bounce and it doesn't bounce on up because maybe I'm using a different time frame than everyone else. So that's why I'm not the biggest fan about these, right? That's why I'm not the biggest fan when I take a look at these. And I always like, I don't ever even use them, these moving averages, okay? So I want to make sure that you guys have a clear sense of that, and that's why we only use them on the daily chart. So let's keep on moving along right here. If we keep on moving along, we are going to be moving towards, I believe, our oscillators next, right? And we are going to be going towards our oscillators, which are above and below. Now, your question may be, hey, Dek, well, do you use anything on the minute chart? And that's something I do want to bring up very quickly. I do use one indicator only on the minute chart. And if you guys do not know what that is the VWAP. So I use 3 different indicators on the daily chart. The daily chart is, of course, going to be the 50-day moving average, going to be the 200-day moving average, and going to be the 13 EMA. Now, the only one I'm going to be using on the actual 1 minute chart right here is going to be the VWAP. The VWAP is the volume weighted average price. And as you can see, it's a very popular indicator. It's one of the, the few indicators that come up, standard right on, trade ideas right here, because the VWAP is an indicator that a lot of traders and the majority of traders are going to use. So let's just switch back into about a 1 minute time frame right now. Let's turn off pre-market and let's just take a look on STAF. STAF, we have a 1 minute time frame. And the VWAP right now is sitting right around that 245-ish mark, it looks like, right? Right around the 245 mark. If I switch to a 2 minute time frame, we still have the VWAP right around the 245 mark. And if I switch to the 3 minute time frame, we still have the VWAP right around the 245 mark. And if I switch to the 5-minute time frame, we still have the VWAP right around the 245 mark. So can anyone guess why do I use the VWAP and not the moving averages? Well, Dek, I get it. It doesn't matter what time frame you look at or what time frame everyone else in the world looks at. Everyone's going to have the same price. Exactly. Right? So again, why do I use the VWAP? Because it doesn't matter what time frame people use. The VWAP is always going to be the same. And that's why I love seeing the VWAP, and that's why I love using the VWAP. People are going to use the indicators on the daily chart the most because that's the most popular. The VWAP I only use on the minute chart because that stays the same no matter what. Okay? So now let's start talking about some oscillators. Oscillators, as we learned, are going to be on the top or bottom of the charts. Let's talk about some of the most popular ones. Okay? So the most popular oscillators that you guys are going to want to be using is going to be the RSI. Now, the RSI stands for Relative Strength Index. The Relative Strength Index is a momentum indicator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other assets. The RSI is displayed as an oscillator, a line graph that moves between two extremes and can have a reading from 0 to 100. The indicator was originally developed by J. Wells Wilder Jr. and introduced his seminal 1978 book, New Concept in Technical Trading Systems. We use this only on the daily chart. All right, guys. So before I jump into the great work of our, nice and famous J. Wells Wilder Jr., right, I do want to talk about this one changes every single minute towards, again, a 1 minute, 2 minute, 3 minute, 5 minute. So we only use this on the daily chart. Anything that changes from 1, 2, 3, 5 minute charts, we only use it on the daily chart because we want to have the best momentum possible and we want to have the best reading possible. So what is the RSI? The RSI is going to tell us when we look at a play if the stock is currently overbought or if a stock is currently oversold. So anything that is below a 30 on the RSI, and you can see these little dips right here, little dip right here, little dip right here, that is when the stock is oversold. Anything that is above a 70 or near a 70 on the RSI, that is when the stock is overbought. So if we just want to look at this example, and we could see a lot of oversold little times, the stock got oversold right here. And if we go straight down on this line, what happened the next few days after the stock was considered oversold? It got a nice little spike on up, right? Very cool. What happened when this stock right here came all the way on down and was considered oversold? Then it went on this very big spike, went on this rip all the way on up. Since it went on such a big spike and such a big rip all the way on up, what happened when it got a 70 on the RSI? It was considered overbought and started dropping on off. So we can, again, it's something that you can always do is just go over to www.stockcharts.com, and you can see in the past chart history pattern of a lot of these plays when they were considered overbought and when they were considered oversold and how they reacted. What happened with a lot of these plays. So I just want to kind of type in different examples. CBIO, anything big on CBIO right here that can tell us. Let's just go towards, let me look at some of the top gainers today. Go to some of the top gainers today. HBP, anything right here? Okay, cool. HBP is a good one. So we can take a look over on HBP. And let's, again, just take a screenshot of HBP right here. In HBP, as we already talked about, we can see that this play, we know whenever the stock is above a 70, it's oversold. Or overbought, excuse me. So it's overbought, and guess what? It is overbought. What happens when the stock is overbought? Well, we can, again, go right on down because the stock is considered overbought. Here's the tops, and guess what happens when the stock's overbought? People sell it on off. And notice, again, what happens when the stock comes down here and the stock is considered overbought. It starts fading on off. And when the stock right here is overbought, what do you think is going to happen in the next 2 days or so? It's probably going to start selling its way on off. So the RSI is going to be such a great indicator to tell us, hey, we probably want to get out of this play soon, right? We probably want to move on with this play soon. Hey, we probably don't want to be touching this play at this time, if it's considered overbought, because that's where we're going to have a very big drop off soon. And if the stock is oversold, we may want to say to ourselves, hey, let's look for a possible entry. We have more room to climb than we do to fall. So that's always nice to look at. So what else is there? Well, we already talked about the VWAP a little bit, right? The VWAP, volume weighted average price. It's the trading benchmark used by traders that gives the average price of security and has traded throughout the day based on both volume and price. It is important because it provides traders with insight both on the trend and value of security. Again, most popular indicators are the intraday, which we talked about the VWAP already. So why do we use these indicators? As we talked about, these are the most popular. These are the ones that, again, everyone teaches. These are the ones that everyone learns about. If anyone ever says to you, hey, I have a secret indicator, it's not good, right? It's like I have a secret indicator. It's like a secret you don't care about, right? It doesn't mean anything to you. So again, make sure you guys understand the more popular, the more they're used, the better the power they're going to have. Now, some other very popular indicators that, of course, you guys can go check out: Bollinger Bands. You guys can go check out these Comey clouds, relative strength index, moving averages, the MACD, parabolic stop and reverse, scholastics, and average directional index. These are, other very popular indicators that you guys can definitely test and go ahead and work with. Go see which ones you guys like. Add them, of course, on your scanners. Go ahead and add them. If you guys don't have scanners, just go, as I said, to stockcharts.com. Go to stockcharts.com, type in any stock you want. Let's just, again, type in CVIO again, and you can go to the very bottom. Simple moving average right here, that's great. Simple moving average right here, that's great. We can go again, add our 13 exponential, right? 13 EMA, that's absolutely great. And then again, we can maybe try some new things out. Here's the MACD on the bottom. We could test that out. We can go ahead and, maybe add some more. Check out these clouds, right? Go ahead and see what the clouds are like. Okay, how are these working? Some traders love to see these, right? We could go ahead and use the parabolic SAR. You may have to, again, be able to have a membership for that one. But again, it's always great to try to check these out, learn more about them, because you're going to be a better trader because of them. But in this lesson, I wanted to go over my favorite indicators. Make sure you guys understand what they are and why I use them. Everything I say, I always want to back up my credibility. So again, hopefully you guys took some great value out of these lessons. I love, again, teaching you guys these indicator lessons, and I hope you guys are going to become a better trader because of them.